This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Swiss shock. Switzerland's central bank stuns investors worldwide, making an unprecedented policy about-face. But does it signal a potentially big move by the ECB when it meets next week?
And what went wrong with the banks? Earnings are lousy, revenues falling. Some of the biggest banks in America try to explain their tough quarter.
Profit pressure. Best Buy uses a term other retailers haven't: deflationary pricing, and it could be a costly trend. All that and more tonight on Nightly Business Report for Thursday, January 15th.
Good evening, everyone, and welcome. A central bank shocker today, and it wasn't from the Federal Reserve or the Bank of Japan or even the European Central Bank. Instead, it was the Swiss National Bank stunning currency markets around the world by removing the price ceiling on the Swiss franc, designed to keep its currency artificially low against the euro. Now, that sent the value of the franc soaring and Swiss stocks tumbling. Today, the franc at one point up about 20% when it was all said and done against the euro. Now, the defensive move comes ahead of an expected announcement from the ECB's Mario Draghi next week of a massive Eurozone quantitative easing plan, like the one we've had here in the U.S. for the past few years. That would weaken the euro, sending investors flooding into the franc. Louisa Boyesen has more now on today's surprise move by the Swiss National Bank. She's in Zurich.
A Swiss shock. There's simply no other way of describing what took place here on the Swiss markets today. The Swiss National Bank coming through and surprising everybody by deciding to scrap a cap that's been in place, preventing the Swiss franc from appreciating above a certain level towards the euro. At the same time, they took interest rates even further into negative territory. We're now looking at a deposit rate of minus 0.75%. So both those things causing massive market turmoil. You had the main Swiss index, the SMI, down by more than 10% at one point, unprecedented levels. It closed down by more than 8.5%, and we saw it being led lower by the big banks here, off by some 10%. Julius Baer, UBS, for example, these big banks trading lower. We also saw the big luxury good groups, the likes of Richemont, for example, Swatch, the maker of your watches, also off by some 16%. I'm Louisa Boyesen here in Zurich, Switzerland.
So what does this Swiss surprise mean for consumers and for investors? And who, if anyone, might benefit from a more costly Swiss franc? Ever notice how expensive it is to travel in Switzerland? Well, it just got even more expensive. A lot more.
Your cappuccino is going to cost you $10.
Unexpected? Well, Christine Lagarde, who heads up the International Monetary Fund, once thought to be the referee when it comes to global currency maneuvering, was not contacted.
This was a bit of a surprise. I would hope that it was communicated with other colleagues from central banks. I'm not sure it was.
Who benefits? For now, Swiss consumers and anyone already holding Swiss francs. An item costing 60 francs in Davos yesterday suddenly costs only 51 francs today. But those consumers don't drive Switzerland's economy. Exports do. Food made by Nestle and watches by Swatch got a lot more expensive to buy around the world, dimming prospects for those stocks. Swatch CEO Nick Hayek blamed the Swiss National Bank, saying, "Today's SNB action is a tsunami for the export industry and for tourism, and finally, for the entire country." The big Swiss banks face a rocky road ahead, too. UBS, Credit Suisse, and Julius Baer all make a lot of money in U.S. dollars, British pounds, and the euro. Before today, Swiss banks figured a rising dollar would help them in 2015. It's still rising, but they won't benefit as much as they hoped. So why did this happen now? With the European Central Bank expected to announce a new round of stimulus, or QE, next week, in hopes of jump-starting its stalled economy, pressure would have built to uncap the Swiss franc anyway. More euros in the system should lower their value, and Swiss francs would look even more attractive if their price was still capped.
You cannot control your currency forever. The market is going to pressure you to where it wants to go.
By making the move today, the Swiss Central Bank avoided paying out billions of francs over the next few days to keep its currency down, ahead of that expected quantitative easing next week.
All right, let's turn now to Kathy Lean for more discussion on today's surprise move by the Swiss Central Bank. She's Managing Director of FX Strategy for BK Asset Management. Welcome, Kathy. As Sue just explained, if the Swiss bank was going to support or continue its policy, it was going to cost them billions to do so. I understand why they did it in that sense. Does this in any way signal to you something about the inevitability of the European Central Bank's quantitative easing move or its size, and do you think they talked?
I'm pretty sure that the SNB conferred with the European Central Bank before they made this decision. As your package indicated, we basically have this being a monumental move. I mean, this is a historic move on the part of the SNB. They're taking a lot of risk by putting their currency, at a higher value that really does, put a big impact on growth versus, exports versus imports. But the story here is that I think they would not have done that if they weren't confident that the European Central Bank was going to move forward with quantitative easing. So yes, I'd be shocked if Jordan didn't necessarily confer with Mario Draghi beforehand, before making this monumental decision.
So, Kathy, how low then does this make the euro, the possibility of the euro going? What levels do you see the euro moving to now that the cap has been taken off of the Swiss and we are facing possibly historic QE next week?
I think in the long term, it's very realistic for us to see euro at parity with the U.S. dollar, which is something we haven't seen in a very, very long time. But I think in the shorter term, what you're going to see is more volatility, more jagged price action. What you have to imagine is that the Switzerlands have left the markets, the Swiss have left the markets as one of the big buyers of euros. So obviously, that's going to be negative, and that's going to drive the euro lower. And as we head into next week's European Central Bank meeting, we could see further selling. But on the flip side, what I think investors have to realize is that trade is very crowded. And when you get such a crowded trade, and the market itself, while they feel pretty confident, I don't think they're absolutely certain that the ECB is going to announce QE. And even if they did, there's a lot of kind of debate on the size and scope of the program. So there could be some reversals and some profit-taking before the ECB meeting. And that could lead to a bounce, giving traders and investors opportunity to sell once again.
So, Kathy, you see the U.S. dollar potentially strengthening even more against the euro. And just as Sue explained in the package, when a currency strengthens, that makes that nation's exports more expensive in international markets. So, does this mean the strengthening of the U.S. dollar, which we've already seen a lot of and we may see more of, does this mean that U.S. exporting countries are going to have a harder time selling into Europe?
Yes, I do think that U.S. exporters will struggle as the dollar continues to rise. And I think this is a realistic trend that's going to continue, because all of these uncertainties and events that are happening around the world, they're not coming to an end anytime soon, because you're seeing a lot more central banks like India and Egypt today respond to the Swiss movement. And the key here is that everyone's flooding into U.S. assets for safety. And that basically drives the dollar higher. That's why treasuries are doing so well. So for multinational U.S. corporations, it really depends what their business is. If they export a lot, they're definitely going to be hurt.
Kathy, very quickly, what does this mean, if anything, for the Federal Reserve here in the United States?
I think for the Federal Reserve, they remain on track. Of course, volatility is never good for central banks, so they may, lean back a little bit, and we've seen a little bit of a drop in commodity prices. But at the end of the day, I think they remain on track to tighten before the end of the year.
For the first time in my life, Kathy, I actually understood a currency conversation. Thanks very much. Kathy Lean with BK Asset Management. We appreciate it.
Thank you.
Well, today's stunning move out of Zurich was good news for investors in Swiss-based companies that trade here in the U.S. and therefore are priced in U.S. dollars, because the dollar is stronger than the Swiss franc now. So let's take a look at shares of the drug makers Novartis and Roche, as well as Credit Suisse Bank. They all ended significantly higher on a percentage basis today.
And to U.S. markets now, overall, stocks ended lower again today with another triple-digit loss for the Dow after more disappointing bank earnings. We'll get to those in a minute, and some weaker than forecast economic data. Initial jobless claims last week rose by 19,000 to the greatest number in 18 weeks. More seasonal workers than expected apparently were cut loose after the holiday season. And despite lofty inflation targets by the Fed, wholesale prices in December fell by 1/3 of 1%. That's the largest amount in 3 years because of that tumble, yes, in oil prices. And with that, the Dow was off 106 points, the NASDAQ down 68. Lower now for 5 days in a row. The S&P 500 down 18, closing back below the 2,000 mark. Now, with all the upset in the currency markets today, Treasury prices climbed as investors clambered into safe havens. That pushed the yield on the benchmark 10-year note lower to 1.72%.
And more now on those disappointing earnings from Bank of America and Citigroup, both released before today's opening bell. Citigroup reported a sharp drop in fourth quarter profits. Bank of America also out with disappointing results. Shares of both getting hit today. And these reports follow soft results from JP Morgan. So what went wrong with the big banks? Kayla Tausche takes a closer look.
The fourth quarter has little to like for big banks, which often serve as a barometer for broader economic health in the United States. Bank of America and Citigroup seeing a broad slowdown in loan growth as well as a sharp decline in trading activity. In particular, bank executives calling the trading environment challenging, turbulent, unpredictable, and volatile, causing revenues in the fixed income units to drop across the board. Citigroup's down 16%, Bank of America's down 21%, and JP Morgan's down 23%. Now, executives blamed volatility on sliding oil prices, interest rates, as well as volatility in currencies like the euro, the yen, the strengthening dollar, and the declining Russian ruble. It's a peculiar change, though, from a tone that they used to take where they said volatility on the whole is good because sharp moves in either direction for securities would cause fee-paying clients to decide whether to buy or sell rather than hold. Bank of America's Bruce Thompson saying that may have helped equities, that sentiment to buy or sell, but not other parts of the market. Goldman Sachs has long been the leader in this fixed income space, which has investors on edge because that is the next bank to report earnings, and it could be more of the same. Now, traditionally, the biggest worry for U.S. banks is what giant legal charge they're going to have to take in the quarter. Bank of America surprised investors by having relatively muted legal costs, but charges did mar the overall earnings of Citigroup and JP Morgan, which took charges of $2.9 billion and $1.1 billion respectively, largely to cover future settlements for alleged currency manipulations. Now, as performance underwhelms for the banking sector, the question that looms large is whether the big bank model is past its prime. Citigroup CFO John Gersbach acknowledged this, saying that the company has looked at other models, but they've decided instead to keep a simpler structure. JP Morgan's Jamie Dimon fiercely defending the big bank model, at least for now. One thing is clear, though, if performance does not improve, it might not be up to the banks to decide. Investors might be demanding something different. For Nightly Business Report, I'm Kayla Tausche in New York.
Attention Target shoppers. After struggling and failing to turn a profit at its Canadian unit, the discount retailer is shutting all of its stores up north, 133 of them. CEO Brian Cornell says it is the right decision for the retail chain, and he will now focus on revitalizing the core U.S. operations. Investors cheered the news, sending shares of Target nearly 2% higher today.
A very different story for another big retailer, Best Buy. Shares of the electronics giant tumbled today, down 14%. The problem wasn't last quarter's numbers. They were okay. But investors didn't like what they heard about 2015, especially something management described as, quote, deflationary pricing. Courtney Reagan has more.
Today wasn't Best Buy's best day. Even though the consumer electronics retailer released better than expected holiday sales, fueled by consumer purchases of TVs, mobile phones, and computers, it also warned investors that the holiday strength won't stretch into the first quarter, sending shares plunging. The retailer says industry changes, including deflationary pricing, weak demand, and declining purchases of extended warranties, could pressure profitability.
There's no such thing as, an increase in price for consumer electronics. The only time you ever get higher prices is if a brand new product comes out. There's nothing new coming out. 4K TVs aren't going to save them. deflationary prices will kill them. Yes, price competition online will kill them. So everything is working against them.
The National Retail Federation's chief economist, Jack Kleinhen, says there was a high level of price competition this past holiday season, explaining further that while volume of purchases remained high, lower prices offset some of the gains traditionally expected from selling a high volume of goods. While other retailers have yet to specifically point to deflationary pricing as a concern, some experts think it's a big problem that can't be ignored. And as pricing has gotten even more competitive, retailers selling identical merchandise are more at risk.
I think everyone in retail this holiday is facing deflationary pricing pressure, just because of the degree of discounting, not only the depth of pricing, but the duration in which events have been running. Black Friday started after Halloween this year, not after Thanksgiving. So the sheer amount of time the customer's been exposed to lower prices causes your average transaction values to decline.
So while heightened competition is good news for consumers getting the benefit of lower prices, it's a costly trend for retailers. For Nightly Business Report, I'm Courtney Reagan.
And still ahead, why Toronto, one of the leading financial centers of the world, finds itself on edge as oil prices drop. Earnings after the closing bell from Dow component Intel. The tech bellwether easily topping Wall Street forecasts for earnings per share at 74 cents, excluding certain items. Revenues rose about 6.5%, just edging out the estimates on solid sales of chips for servers. Its PC chip business didn't fare quite as well. Shares initially fell in after-hours trading. Josh Lipton now with his one big takeaway from Intel's report from Silicon Valley.
The big number from Intel's latest earnings report, $8.9 billion, that is the revenue Intel said it generated in the fourth quarter from its PC client group. Intel's PC business accounts for about 60% of the chip maker's revenue, so that is the number to watch. And revenue in that division did rise 3% year over year, though it just missed Wall Street's expectations. Analysts had wanted to see revenue of $9.2 billion. Signs of stabilization in the PC market helped Intel stock surge higher in 2014. It was the best performing stock in the Dow. Whether that tailwind continues is the big question for investors this year. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
Also out tonight, fourth quarter results from the world's biggest oil services provider, Schlumberger, which is working to combat the steep drop in oil prices over the last 6 months with improvements in efficiency and some likely job cuts. The Texas-based company made $1.50 a share, excluding items, and that topped Wall Street forecasts. Revenue of more than $12 billion was just shy of what the street expected. The company also announced it is increasing its quarterly dividend. Shares initially rose today in after-hours trading, as you see there. Morgan Brennan joins us now from New York City with her one big takeaway from Schlumberger's number. Morgan.
Hey, Tyler. Well, you know, the headline numbers, those earnings that beat street expectations, the 25% increase in the dividend, certainly positive for the oil field services giant. But when you start to dig through this report, you see that Schlumberger incurred about $1.8 billion in one-time charges for the quarter. And that was a direct result of the price plunge that we have seen in oil. We're starting to see that really impact this company. So one of the biggest ones there was 9,000 job cuts that the company announced and began to roll out in the fourth quarter. That's happening across the globe in all of its operations, but also seeing the company taking a hit on an Eagle Ford shale project, restructuring of its seismic vessel fleet, Venezuela currency devaluation, and perhaps most importantly, the company is cutting its CapEx, its capital expenditures in 2015 by 25% over 2014. And so that's a really important number that everybody's been focusing in on with all of these energy-related companies, because as oil declines, as production potentially declines, we're going to start to see the expenditures tied with it decline, and that's going to have ripple effects out into many, many different industries. So we're seeing that here today.
Hunkering down at Schlumberger. Morgan Brennan, thanks. Morgan in New York.
And indeed, just today, oil prices ended lower once again in a choppy session despite a midday rally. Domestic crude fell more than $2 to $46.25 a barrel. Brent crude fell $1, settling at $47.67 a barrel. And that trend in lower oil prices is really sending shockwaves to oil-producing regions of the U.S. and throughout the entire Canadian economy, sparking fears about a slowdown in real estate, bank earnings, and in trade with the U.S. Brian Sullivan has more from Toronto.
There may not be oil here in Toronto, but it seems to be the one thing that everybody is talking about. Because while there is not a drilling rig in sight, concern about the larger impact of the oil shock has the city on edge. Toronto is one of the leading financial centers of the world, and the banks that are based here rely on the oil companies for a big part of their earnings.
This is a macroeconomic story. The banks in Canada have $55 billion of economic exposure to the oil and gas industry. If you've looked at the Canadian bank stocks, they've been negatively affected significantly.
There's concern that if bank earnings fall, lending and the broader economy may also take a hit. Because while oil, gas, and mining make up just between 8 and 10% of Canada's total economy, industries such as real estate, manufacturing, and construction represent a far larger piece. And there is real concern those sectors could also be impacted.
Canada is totally reliant on the natural resource sector. 25% of all of the Toronto Stock Exchange is represented by resource stocks, specifically oil and gas. All of the growth of employment in Canada was represented by Alberta. Alberta will probably go into negative GDP growth. There are so many other businesses that are suppliers to the oil and gas sector negatively affected. So this has far-reaching. We are a natural resource economy in Canada.
What happens here matters to the U.S. Canada is America's largest trading partner, accounting for about 17% of all American exports. So if we see a slowdown here, it could take its toll on American companies selling into Canada. And it is just another reminder that the oil story, though early in the year, is the defining economic story of 2015. For Nightly Business Report in Toronto, Canada, I'm Brian Sullivan.
Those tumbling oil prices means two oil majors will cut jobs, and that is where we begin tonight's market focus. BP and ConocoPhillips announced they will slash more than 500 contracting positions in the North Sea to reduce costs as crude prices have cratered. Shares of BP actually ended slightly higher at $35.73. ConocoPhillips off almost 2%. It finished at $61.41. A warning from Lennar sent shares much lower in today's session. The home builder saw its profits jump by 50% as it sold more homes at higher prices, but it reported its first fall in quarterly margins in 3 years and forecast a further drop in 2015 as costs rise. That sent shares down 7% to $42.48. Investors poured a record amount of new money into BlackRock last year. The firm hiked its quarterly dividend by 13%, increased its buyback program, and despite that, its profits slipped slightly and revenue came in a little bit below estimates. Shares off almost 1% to $342.45.
Southwest has been fined more than $1.5 million by the Department of Transportation for tarmac delays. The airline failed to follow rules last January when 16 of its aircraft were delayed on the tarmac and passengers were not given the chance to get off the plane after 3 hours. Shares fell more than 1% to $38.90. And shares of Pilgrim's Pride jumped after that company declared a special cash dividend of $5.77 a share. That payout will cost the chicken processing company about $1.5 billion and will be paid in February. The stock popped more than 9.5% to $34.57.
Coming up, the Chinese company with a new phone and big ambitions to take on Apple.
This may be the last call for Radio Shack. Already dealing with creditors to have enough cash on hand through the holidays and to keep its doors open, the Wall Street Journal now says the struggling electronics retailer is reportedly preparing to file for bankruptcy protection as early as next month.
Good news if you're a fan of Cuban cigars. Starting tomorrow, the U.S. will ease up on travel and trade restrictions to Cuba. Americans who go to the island nation will no longer need a special license, and neither will American Airlines or travel agents. And you can now use U.S. credit cards there. Some U.S. companies will be able to sell technologies into the country, and Americans will be able to bring home up to $100 worth of alcohol and tobacco from Cuba.
And finally tonight, Chinese smartphone maker Xiaomi is taking direct aim at Apple, releasing a brand new phone and tablet today that will cost about a third less than the iPhone and the iPad. So, will it sell, and should Apple be worried? Eunice Yoon has more from Beijing.
Xiaomi means little rice, but this Chinese company has big ambitions. The company launched today the Xiaomi Note. This is going to be a direct competitor to the iPhone 6 Plus. Now, the phone comes in two colors, black and white. It also has an important camera function, the 4-megapixel camera at the front, as well as a 13-megapixel camera at the back. But the biggest selling point, the company says, is that this phone is thinner, lighter, and a little bit shorter than the iPhone 6 Plus. This phone marks a bit of a departure from Xiaomi's current strategy. The phone maker is known for its budget smartphones. The standard version of this phone is going to be $376 US. However, the Pro version, or the upgraded version, is $540. Still, though, cheaper than the iPhone 6 Plus. One of the other points that the company's CEO made was that not only does he want to be dominant in the Chinese market, but he also wants to be a dominant player in the world market. He says that he's hoping to be the biggest smartphone maker in the world in the next 5 to 10 years.
For Nightly Business Report, I'm Eunice Yoon in Beijing.
Wow, that's a story worth following,
ambition, right?
That is ambition. All right, that's it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And I'm Tyler Matheson. Have a great evening, everybody, and we'll see you back here tomorrow night.